All right. Good morning, everyone. Welcome back. It is our Tuesday talk with the one and only Brannon B2R Investing. So, good morning, man.
Morning. It's going to be a great morning. I'm looking forward to this.
It-
Um, I
we have
think
to take a pivot on our topic a little bit.
I think it all ties together because it's about cash flow.
hmm
So this all fits together.
but what was the original topic that we? Oh no, but it was what is the optimized cash flow, right? Or what was
Yeah,
your?
what would be the optimal starting position in cash flow? And that was part of why I put it out in a sort of a poll form in our school community of seeing what everybody thinks is the optimal. And I didn't put my thought until later in the discussion.
Well, hold on. We have a special guest, so he is joining us. I think we interrupted his nap, but let's bring him in real quick. There he
All
is.
right.
Howdy.
Howdy, so good morning.
Hello.
I haven't
So,
interrupted a nap. I was getting ready to go to bed because the sun's coming up. Zuber was on. I was like, yeah, that means it's time to stop gaming and get some sleep.
yeah, so this was a last minute invite for Dion, but thanks for joining us. So we did slightly pivot on our main topic, but it all relates. But the 50-year mortgage has been a big topic. You did a video, Zuber did a video also, and Brannon said he thinks he can convince you. He thinks he has a different
I'm
point.
thinking I can have a healthy discussion. And if I have the thought correct, I might sway you a little bit.
I can
But-
derail you with 2 sentences before you give your argument.
Okay.
I don't care if the bank makes 10 billion, trillion,
Okay.
quadrillion dollars
I
if I
get
get
it.
my yield. So it's not about what the bank makes.
I get it. I get
There you
it.
go.
All right. So
Go
so
ahead.
let's go, Brandon. You had your whole spiel of presentation.
Nope.
So
I
okay.
get it. Because I thought of all these discussions. Because let me just say, I love this healthy discussion because I believe in as iron sharpens iron, we get better. All of us. To say I am the sum of all knowledge and wisdom, I am not. I'm learning from Dion. Well, every now and then I learn from Marc, but not.
Yeah, I don't try to. I'm
But it's
not. This is
good.
for
Yeah,
entertainment.
it's good that we have this healthy discussion.
I learned just as much from the person who doesn't even own a rental yet as the person with experience. I learned that as a CDL instructor. The brand new student taught me things that the instructors didn't even know.
Yep, I agree. I agree. So let me go into a little of my thought and tell me. I want feedback. So, all right. So I understand we love the 50-year mortgage with the extra cash flow. That is appealing. And I said, and I spent 2 hours last night working on these formulas because I wanted to see, tell me the truth. I'll go either way, but I had to find out what I thought with my assumptions, which is better. So I took, do any of y'all spend time doing, this is a present value of future cash flows. Okay. This is what I learned as a CFO. When people are analyzing investments, they're saying, what are those future cash flows or future expenses worth today? Let the numbers tell us what is the right thing to do. Don't impart a feeling. And so what I was trying to do my best is not impart a feeling and let the numbers. And I'm saying I use numbers, so some pieces of it are an assumption. So I was trying to be reasonable. So let me go into that. So I'm saying that I would assume that a 50-year mortgage would have some higher interest rate. We don't know what that would be right now. And even thinking, would the federal government subsidize that rate in some form? There might be. So I looked at the 15-year and the 30 and said, what is the difference in those numbers? I'm going to use a round number of about 0.5%, not a percent. I first said 1% last night, and probably some of y'all saw that in school, but I spent more time on it because I want to be accurate. I want to be right in giving advice. And so I used 0.5%. Then we talk about inflation because we have inflation-based debt destruction. So you have to factor that in. I used 3% because that's the number it is today, saying, okay, going forward, we're not going to average 2, we're going to average 3. So then you have to use that present value. And so I looked it up. I used an average loan of 400 grand. I think that's a reasonable number to look at because that's a value both for owners and just a typical price out there. And I said 400,000 at 6.5% for 30 years comes to a payment of 2528. Total payments are $910,000. I'm going to use round numbers because it's easier. 910. But then we need to use present value of future cash flows. We have to assume inflation-based debt destruction, 3% inflation. So what are the present value of those dollars being paid back to today? 910,000 equals $599,000. Now I factor in a 50-year, and I'm looking at 400,000, saying 0.5% higher, 7% on 50 years. The payment comes out to 2407. So we're talking $122 difference. We all like that. I like that. But let me look at what the numbers say. Am I paying more? Yes, the interest is more. We all agree with that. We know the interest is more. The total amount comes out to 1.444 million, or 1,444,000. Using the same 3% inflation-based debt destruction, it comes up to $747,000. That is a difference of $148,000. But we need to add now back the cash flow. So I'm factoring all these things because we want the extra cash flow. Well, I'm saying the cash flow is $122 a month for 12 months, or 12 times in a year for 50 years. It comes out to $73,000. Well, I'm going to hold my money accountable, and I'm going to make, if I can make 10% return on my money, which we all use that number a lot, 10%. Well, now I've got to do present value of those future cash flows too. That 73,000 is worth 145,000. That is a net loss of $3,000. The factors that make it worth it is if I can make more than 10% or the interest rate is different. The numbers tell me in today's present value of all the savings going forward, you lose $3,000. There's a lot of what I based off of my decision.
Oh, you're muted.
So, Brannon, can you explain to me? So we use the Socratic method of debate. I'll try to explain yours to your satisfaction. Yeah. You try to explain. Okay. Tell me what the Cantillon effect is.
I've heard you mention it, and I don't remember what it was.
Okay. So this is something the uneducated economist has educated a lot of people about, right? Simon's super smart, way smarter than me.
Right.
So this is the butchered crayon-eating Marines version of the Cantillon effect. And for some reason, we're not live on my channel yet, Mark. Don't know if there's a reason. Imagine a classroom full of students. There's cookies on the teacher's desk. And the students use the cookies as a currency.
I heard that. You mentioned that. Yep.
So I'm going to explain it for anybody watching in case they don't remember. The students use the cookies to trade for pens, pencils, crayons, anything that they use in the classroom. And everything has a value. And then the next day, the teacher brings in 100 new cookies. So it's going to take more cookies to buy the stuff, right? But the teacher isn't fair. And she goes, hey, you're my favorite students in the front row. You're the teacher's pets. You get the cookies first. So those students, before the inflation hits and things cost more cookies, get more cookies to use. So they buy things that then appreciate in value and later take more cookies to buy. So they can buy the pen or the pencil or the crayon today for a cookie, and next week they could sell it for 2 or 3 cookies because there's more cookies in circulation. So the Cantillon effect means that monetary policy shows us that the people who get access to the currency first win, because you nailed it, inflation-based debt destruction. inflation itself, not just the debt destruction. Owning the asset as inflation happens makes you wealthier. So it's not that the 50-year mortgage is good or bad. It's that people have to pay attention to the window of opportunity, right? The students who got the cookies from the teacher the first day, they win. But next week, the cookies have all kind of balanced out and everybody's trading at a value again. So there's a window when every boomer, right? The boomers, everybody goes, oh, it means you're old. Yeah, we're all going to get there. Unless you're not lucky, you don't get there. But all the boomers going, oh, this 15-year mortgage is great. Anybody who goes with a 30-year mortgage is a retard. Look at how much more you're going to pay in interest. Look at how much more the bank's going to make. Look at how much more inflation doesn't offset what you're doing. 30-year mortgage is terrible, but everybody now has homes based on 30-year mortgages. There are people who, for some reason, want a paid-off house, which is the last thing I want. That's why I would do a 1,000-year mortgage or interest only forever, because wealth isn't created by principal pay down. If you bought a house, and Mark, did you enable screen sharing?
I didn't see it. So try, if you can try pressing one more time. It keeps disappearing on. There we go.
If you bought a house in 1970 with a 50-year loan, you paid what, 20 grand for it?
Yep.
30 grand maybe. So today you'd have paid down 20 or 30 grand. But what's a house worth today? 300,000, 350, according to this, median. I guess that was 2020.
Yeah, a little over 400 now.
Yeah, it's a little over 400 now. So you could have made $400,000 in appreciation in 50 years, or paid down 20 grand. Who cares about the 20 grand? Zuber said, oh, my mom wouldn't be able to retire because she'd have a mortgage payment. No, she'd have a 1970 mortgage payment. She'd owe 20 grand if she never paid a penny for those 50 years. She'd have made 480. And people go, well, you don't have access to that because it's in your house. Well, if it's in your house, you don't have access to it either. That's why Tom Selleck made gazillions of dollars with reverse mortgages. That's why people do downsize. And that's why there's a housing lock right now. It's not worth downsizing because people owe on a house in 60 or 70 years old, and they have a 3% mortgage because they refinanced or pulled equity out in 2020 when rates dropped to zero for the Fed. And now they have all of this money tied up in a house. If they move, they're going to have a 6 or a 7% interest rate. But if you have somebody that owes $20,000 or $30,000 in comparative dollars, they buy the house today, in 50 years, yeah, it's going to feel like $400,000 is going to feel like $20,000. People will have over $1 million salaries in 50 years if we're still using the dollar. If crypto hasn't done its thing and completely replaced it, and believe me, if the dollar falls apart so much that people are making $1 or $2 million a year, the best thing to do is to be in debt, because it won't be the currency of the land. People will be using something else. And what I want to do is owe the bank a bunch of money that has no value. So Zuber isn't right or wrong. You aren't right or wrong. There isn't a right answer. It is unique to each individual. But there is a window of opportunity, which I'm trying to tell people you have to pay attention. Because when you can buy a house and people buy based on payment, there will be a lag effect where people don't realize my $460,000 house, people can pay $700,000 and the payment's the same with a 50-year mortgage, unless they really screw up the interest rates and go much higher. We don't know what the tipping point is on that bell curve. They might go, we just want the consistent payments. It's the same interest rate. It might be 5 points higher, not half a point. Who knows? We'll know when it gets here. But the 40-point renewals, they were, like you said, about a quarter to a half a point above the 30-point. And then home prices are going to reflect the new increase and have a 50-year mortgage, and the payment will be the same. And now you can start going, yeah, you're going to pay more in interest. The bank is going to make more. You have less of an impact. But if we have that window of opportunity, and if right now everybody's just, I'm digging my heels in, 50 years is entrenched slavery for my life, I'm not going to do it. They'll miss the window of opportunity to save hundreds of thousands of dollars over the year of the life of the loan because the house prices didn't adjust quick enough.
Right.
And they'll worry about what the bank makes. Why do you think so many investors that have 10 decamillionaires, tens of millions, do interest-free loans? Because they get the chart. Today it's $20,000. That's what it was in 1970. Was $20,000. That's the $20,000 of today. In 50 years, in an interest-only loan, you made over $400,000. The best you could have paid off is 20 grand. But compare that to today's dollars.
No, I I get what you're saying. You're right. There is a window. The moment that that's offered, You have a window to
Hey.
buy. My wife's in the other room. I'm not getting that kiss. I'm sorry.
That was the championship. That was a win right there. That was
That
her saying
is.
you won.
She won. You won. Yeah. No, I mean that's a valid point too. There is a window before the values change going from 30 to 50. There will be a window, but at some point that window catches up. And then my discussion comes in, but then every purchase is going to have these same principles of a net loss.
But do you care about the loss?
Yes, because it's real.
So
I'm
let's
using
you
present
said the net
value.
loss.
It shows it's real.
I'm sorry. Go ahead.
What I'm saying is the present value calculation, if you've got it right, shows that it's real dollars lost to you.
Correct. And in 50 years that you're doing the full amortization of the loan, in
Yes.
50 years, what will $3,000 be worth?
But it's factoring that in. That's what using present value calculation is. It's saying to today, you gain nothing doing that. It's factoring all of those things in there, saying today it is a net loss to you.
Except there are the people who want to win the purchase and they can offer more. They can offer more on a property and the net loss over a 50-year period is $3,000.
Right. But
Right.
it's real dollars.
People outbid each other 20 or 30 or $100,000 to get deals all day long.
And where I would agree with you, because I'm looking at this 10%. I'm saying I'm going to make 10%. I know for a fact I can make more than 10. I make it today with investments today. So if you don't think you can make, if you can make 10 or less, it is a net loss to you making that choice. If you know you can make more than 10, which is also from the purchase, we agree. It's from the purchase and the cash flow, which I know I can make more than 10, it becomes a absolute positive number.
So here's the danger of math. Because when math is right, reality kicks it in the teeth. Brannon, tell me a little bit about your portfolio. How many rentals?
12.
12. Year one, if you got a 10% return, we're dancing, right? Like that's a home run, kind of. In my market, it is.
Right. Yeah.
I guess in Gary, Indiana, Mike wants a 20.
Yes,
Gets a 20,
exactly.
right? Probably gets a 20. So year 5, what's the average? What's the average return on your worst rental at year 5?
I have not hit year 5 yet, so I'm at 4. But let's say 4. Here's the unfortunate thing that has happened in the last 4 years. Rents have come down. So my return has actually gotten thinner today than it was 4 years ago. On the first one, on the second one, on the newest ones, my returns are the best.
So in the last 5 years, your rents have gone down?
Yes.
So, market wide, they're up about 40%, right? So what market
not
are you
in DFW, not in Dallas Fort Worth.
DFW? Okay.
The rents are down here about 7%.
And are you in Class A properties, B properties, C properties?
It's a little bit subjective. These are brand new builds. So what would people classify those?
Okay. So
you're saying B plus, something in that.
I've never seen a new build in the last 20 years that would make a penny, right? So that's an investing strategy you're choosing to do. And that's not one that I would say to do in Washington. If it's built 2006 or later, I wouldn't even look at it.
Yeah. Every market's different. Every market's different.
Right. So if you buy a property that has a return, by year 3, it's 30 or 40%. It's not 10.
Right.
And it's got to be 20 years old or older. And unless you're in Matt's world, it's got to be 100 years in the Boston area, right? The East Coast is very different. But I mean, you make my point. And it's a little frustrating to put out content and to have people that say, I watch the content, and then they go, I'm going to buy a new build. Or we've got friends that go, I'm going to buy in 5 different markets. And then when one is not performing, we go, why isn't that? Well, you're not mastering a market. You got to pick a market.
Yeah.
And then you got to pick an asset class. And then you have people that go, well, I'm going to build it. And then they get frustrated because building sucks or the permit process sucks or whatever. And we go, look, there's a really stupid, lazy way. Look on the MLS, find a cash flowing deal. It's got to be this old. I want a Class C property. I don't want it too fancy. Like, here's the playbook. And almost everyone goes, that's great. Here's how I'm going to tweak it. And then it doesn't do so great.
So, like I said, every market's different. And you look at markets like your market, because it's so heavily regulated, you still have land around you, but it's so heavily regulated to build, it doesn't make it worth it. My area here in Texas, we have tons of land, less regulation, and there are some opportunities. It's not like it's everywhere, but there's some, like these new builds. I've got 2 new builds about to start this week. It's going to be my highest cash flow. I'm talking starting at, now I'm assuming you're trying to think out ahead of what interest rates are 6-9 months from now. So I'm trying to make reasonable projections. They'll be starting out between 12 and 15% cash flow, which is awesome. And these are new builds. It just depends, where is the opportunity? Like you're saying, we've said this before. Not the way I do it is not right for everybody. It's just right for me in the opportunity here. Everybody's opportunity is a little different based off of where they're investing. You got to just know where that opportunity is.
I think it's entirely possible, but I think the business model shows that new builds do not make money for 5 to 10 years in any market. I've never seen it. I've never heard of it. So if you do it, I hope it works. It would be great. It just hasn't happened yet. So you're not reinventing a wheel. You're trying to slide the car along on the ground with you. You're just dragging it.
So you saying, I'm curious, what makes it not worth it? Or do you want me to share where I'm at and maybe you can explain it?
So the cost of building a house right now, because of the permit process, now Texas has some counties that are great, but DFW, there's some bluer areas where the permit process is getting stretched out. Average is $97,000 basically to just go, hey, I want to break dirt, versus materials versus what you can get for rent. What new builds do is they push rents up. You have to get market rents to rent that out. I could take my rents, and my tenants watch my content, so maybe it's great that we're not on my channel right now, but I could drop rents 50% and I'm still positive. That's what happens when you buy an older property. When you have a new one, everything's got to line up. The rates have to do their thing. The seller, the builder has to usually do concessions. They won't lower price because that lowers the price on all of their sales, but they'll do concessions and add backs and buy your rate down for you and everything because that doesn't show up in the sales price. But so here's what it is. It's a better play to buy a new building than a 20-year-old building.
You actually know your numbers.
If you're planning
better, there's less unknowns.
If you're planning for a decade from now, it's a decade play to build a new building or buy a new building. It's not I want cash flow next year play.
Can I share mine?
You can share it, but you did say you've been doing this for 5 years and rents have come down. Everywhere else in the world, not new builds, rents are up 40% basically because of the pandemic. Right. So you're in the one asset class that took a hit to the face and you're going to do it again. It's going to take a hit to the face. It's taken a hit to the face for 50 years that I've been here. I've never seen anybody invest in new builds, not make money. Well, they'll make money after 10 years, but they're probably not the owner. At some point, they had to get out of it. They had to make some concession or drop or say, oh, I've lost enough, I'm out of here. Go ahead.
So the first build, let's go with the first build. So I build this fourplex for $447,000. It cash flows almost $350 a door from day one. Rents back then were about $150 higher. I was making a cash on cash return of over 25%. Today, it's come down about $150, but I'm still making a cash flow of $250 a door. It is still over 10%. Sorry, my mouth's getting dry.
That's why you got to have the...
Yes. I'm working, so I don't have that. I'm still having fun working. So it's still cash flowing. Plus, on top of that, and I know you're not big on the equity, but it was forced equity. I built it for $447. Now it's worth $720. it's still worth roughly around 720 when I look at comps today.
For home buyers, not for investors. So you've limited the buying pool. If you're not
Yeah,
making money and you owe 4 something on it, they're not going to make money at 7 something with triple the interest rates.
They're not, but I am. But I am. So I'm making that cash flow. These current builds, I'm building them for around 205. They're cash flowing. They're going to cash flow close to 400. I built 2 other ones that finished up this last summer that are cash flowing over 350 a door. And they're worth 265. That was the appraisal, and that is what they're trading for these houses. So I'm renting them and still making money today and allocating for reserves. They are less because my expenses the first few years are less. So I'm gradually moving up my reserves every other year.
And if you had a 50-year loan instead of a 30-year on those ones, those builds are done, you'd have more cash flow every month.
Depends on the rate. Yeah, it depends on the rate.
So based on that logic, you should have 15-year loans then, right? The longer the term, even with a higher rate, you get a lower payment. It's not lower as though the rate were the same, but it's a lower payment.
15-year loan, you would have a higher payment and it wouldn't cash flow.
Correct. So at 30, with a higher rate, you have a lower payment. Now you're not adding 15 years to the loan. You're adding 20 years to the loan. You're going to have a lower payment. Yeah, the rate will be higher, but you will have a lower payment.
Right.
And you'd have more cash flow.
What about this point that, let's see, Ike brings this up, says Dion, oh, not this one. Oh, wait here. I think he's missing the point that Brannon is building these himself and not buying retail. Does that change any of your thoughts, Dion?
Well, so it's probably, so Brannon could probably make more money doing that. But the frustration of building and dealing with a permit office, it's not worth millions of dollars. That's so I think sometimes people think I'm going, here's the best way to do it. And that's not what I'm saying. Brannon nailed it. There's a right way for each person. If I had to go to the permit office once for $100,000 profit, I wouldn't do it next year. I made $300,000 on the place I'm in and dealt with the permit office. I'll burn this place to the ground before I do it again. That's been my experience. So for me, building or permit or AD or anything like that would mean I'll stop being an investor. So is that the best deal for me, even if I could triple my income? Because it would stop me in my tracks? No. They're on the MLS. They cash flow day one. Yes, you have to hunt for them. They use conventional loans. There is a way to do this that has the least amount of frustration and the easiest amount of less effort to reach financial freedom. That's usually the position I'm trying to talk from. And then people go, but if he's trying to say how much money he would make, then the other side makes more sense. Sure.
And I would add, there are some, but I enjoy it. I flat out enjoy building. You don't enjoy remodeling either. You've mentioned that too. And that's okay. I don't even think of it as work. I flat out love it. And putting my own fingerprint on it and starting from dirt and having something later, I love it. And I'm thinking I don't also have any transfer costs later in life when I'm passed away and we're giving these to our kids or taking over the stewardship of them. We don't have to have that 8, 9, 10% transfer cost because it's too old.
So it is the right strategy for you. I will 100% guarantee that's it. For me, it was working at the CDL school the last couple of years, increasing my income. I love the job. I don't want to own real rentals. That's the part most people don't get. I'm not an entrepreneur. You're an entrepreneur.
Yeah.
You want to put your fingerprints on it. I don't want to put my fingerprints on it. I want to wave a magic Jedi wand and get a bigger bank account. Like, it's that simple. And Lynn, yes, it's 8 o'clock in the morning. You can't drink all day unless you start early. And this is it's time to go to bed drink because I've been gaming all night. So it's not like you start your day and then go drive somewhere.
I do see Denzel tuning in from Instagram. He's in Detroit, but he says, yes, permit process is terrible, but I did increase my home value $250K.
Just like me, I got 300,000 of it, and I'm surprised I'm not in jail for what I want to do to the permit office here in Port Orchard, Washington. Not to name anybody by name, but that's the
But here's one thing. I'm not the GC. I have a GC. He's spending about 300 hours on the project. I'm spending less than 40. So I'm holding my time accountable too. So I'm looking at it as, okay, I've got my GC, which I will be building these. These are going to be films for next summer where I'm going to do a series. And then I'm going to interview my builder at the end of the process. So he's making on these single family builds $15,000 on 300 hours. He's making $50 an hour. I'm spending maybe 40. I'll just use 40 on it of the time I put into it to acquisition to now I've got a rental. If you take the appraised value, add that in, I know we can debate that, but it comes out to around $1,500 an hour. I'm trying to hold my time accountable to getting the best return possible. And so I have the best of both worlds. I'm not doing the day-to-day grind of the build. I have a lot of contractors, but he has more that give a better price. So it's worth it for me to have him GC than me having to save that extra $15,000.
So they've done studies that, and there's inflation, so it's probably higher now. But in 2010, they did studies at Princeton that up to $75,000 a year in income, life changes. If you make 20, you're on social programs, right? If you make 30 or 40, you're really struggling. But if you start making 50 or 60, you probably have housing, you probably have a vehicle. Maybe you take a week cheap vacation a year. But when you make 75, above that, your house might be different, your car might be different, your vacation might be more expensive, but the quality of life really doesn't change. Happiness reaches a peak around there, and inflation makes it probably 100,000 now. And the thing the study always missed, and this is what I think you're missing. So Matt, the lumberjack landlord, who is a freaking genius, right? When it comes to math, he can rattle off stuff that just blow. It's probably the guy that's going to stomp me at chess. He did the math on my burr, and I made $3,750 an hour. That was his estimate was $3,750 an hour for the hours that I spent on my burr. But I'd rather make the $700 I make a day from my portfolio playing Dungeons and Dragons online and talking to my friends in Cambodia and where is Scott? I think he's in Australia right now. So I stay in touch with people by playing games all night long because I don't know what time it is where they're at. And $700 went into my bank account. I didn't have to spend 1 hour. So when you talk about your friend, it was $50 an hour and you were $1,500 an hour. It doesn't matter. I mean, maybe if it's $1 billion an hour, so you can I want to impact the world and make change and feed the poor or whatever. Sure. There's a point where working for money is worth it. But the point of financial freedom is to not have to work for money. Because that's the thing the studies missed. The $75,000, if you have to work for it, doesn't equate to happiness. But if $75,000 a year, which is mine is like $240, hits your account and you don't have to spend more than 2 hours a month for that to happen, then the options and the time freedom give you the opportunity for happy. Because there's some people who are just miserable bastards and they're never going to be happy no matter what. But if you have time freedom, and eventually, when you're like, yeah, okay, I've built the portfolio, I've got to the size I want, and even if you can make $1,500 an hour doing your thing, that's still a job. There might be more to life that Brannon wants to experience than I can make money with my time.
You're right, but you're right. You are right. I'm just in growth mode, and I've got to optimize with my skills, with what I'm good at, where I can get to that financial freedom as quickly as possible. And so I'm using what my background of building. I grew up, my family built every one of our houses. We actually have a subdivision named after my mother here. I mean, this is just what I've been around, and I thoroughly enjoy it. So it doesn't even feel like work. And I mean that. Even what I'm doing now, building this business that I have, you know, I'm an entrepreneur at heart. It doesn't feel like work. I come to the office and actually look forward to it. Am I sick or what? But
no, it's a superpower. It's a great thing to know what you are. I'm a W-2 employee. When I needed money, I'm better at working for someone else. I've started a couple of businesses One of them failed because the ex emptied the taxes and wage account, but another one failed because I wasn't in the day to day. I wasn't running the day to day. I just thought I'm going to grow a business the way that the one I'm in is growing, where somebody else grows it, and that didn't work. So I learned by losing a bunch of money a couple of times that I'm not an entrepreneur.
Yeah, and that's why I really appreciate, and as I've gotten older, I think, Dion, you and I are pretty similar. I'm about to turn 54 in December.
Mhm.
I'm getting younger. I used to think my way is the only way. That's just, at least I was when I was younger. That's what I thought. And the older I get, the more I appreciate where everybody comes from, and I listen to it and rejoice in what they love. We have just a little bit different thought on that, and that's okay. We both are, I think our group, we appreciate where everybody comes from, and we're trying to help where we know maybe something is in error. We're trying to help guide them as best we can. And that's what I love about this group. We come from a slightly different perspectives, and it's good sharpening. Even this discussion of where I'm hitting with my numbers, I'm thinking of what you're saying, and I agree. I don't put that piece in there. There are opportunity costs, is what you're saying. When that changed, if I chose to do something different, there are opportunity costs I could be missing.
If you go to buy a house, and I'm trying to be on the topic of the video, if you go to buy a house and they start doing 50-year mortgages, home prices are going to go up, right?
Yeah.
If you go to build a house and put a 50-year mortgage on the end of it and your build cost stays the same, what's that do to your cash flow?
It improves it.
Yeah, but who cares what the bank makes?
I don't care what the bank makes. I just want to make sure I make the most.
Correct. And for me, that would be a 1,000-year loan. Break it up over 1,000 years. And yeah, within a year or two, home prices would go so astronomically stupid that you need 1,000-year loans to buy a house. But in that window of opportunity that I'm trying to wait, I'm trying to ring the bell for everybody. Just go like right now, Zuber's right. It's horrible for everybody. And in 2 or 3 years, it'll be the norm. Like the 30 years, the norm. And that was bad. Home prices went up. But do you care? Like if you could buy the winning lottery ticket, but all of a sudden you had more money than everyone else, would you not buy the lottery ticket? The person watching this video, would you not buy a lottery ticket if you knew you were going to win? Because that's not fair to everyone else. This window where if 50-year comes out before home prices go up is your lottery ticket. But you have to buy it.
Let me ask something of you, Dion, because you mentioned this, and I'm looking at this because you're ahead of me. So I think when I speak in February, it won't even be 5 years yet. Where the big levers seem to be pulled is at that 10-year mark, because you're able to do refinances, and it accelerates the cash flow. So thinking through that, I'm looking forward to that around that 10-year mark, and I do see the exponential hockey stick change. And that's one of the levers you can pull, is that refi piece. So with that, on the 50-year, I put that math, and I'm like, okay, what is the difference? On the 50-year at 400,000, at the 10-year mark, using that rate, you've only paid down roughly $11,000 on the note. And so the refi doesn't make any very little change. Let's just assume rates are similar. Doesn't make that hockey stick go up very severe, versus the current structure. You're paying down between 15 and 18%. So there is some benefit. What's your thought on that?
I'm trying to multitask here to show you. Curtis said this one time in a conversation, PE turned RE. He said, I'm about 3 years in so I'm a third of the way there. Why isn't my cash flow a third of the way there? So at the 3-year mark, my cash flow wasn't even $1,000 a year, $1,000 a month. Sorry.
Mm-hmm.
But math said on the straight trajectory to the 10-year mark that I should be at $6,000 if I want to be at my $20,000 a month where I'm at. But that's not what happened. So it's not so much that the 10 years, all those things can happen. You're at the 5-year point now. How many properties do you have?
12.
12. So you have 12
12
properties.
doors. 12 doors.
12 doors. Okay. How many physical properties?
6.
6. Okay. Right. So very similar. I mean, you're doing way better than I was, actually. I think at the 5-year mark, I had, 4 properties, 7 units. And I was probably closing on the next duplex to get to that point. And so it's when you get to your point where you have 12 properties, 12 units, 6 properties. Right now, you can call your insurance company and say, I want to raise the deductible to $10,000 or $20,000 or whatever the highest that you can handle, because you've got reserves now, and your premiums go down on 6 properties. You can have the binder strategy with 12 tenants and your rents change that amount. You can have, with 12 units, you have more opportunity to find a den or a family room and add value by putting in a closet and turning it into a bedroom, right? So it's all of the levers that are compounding now that you can start pulling that you couldn't do in year 2. In year 2, you had 1 or 2 properties and you were like, oh, I can raise the rents on everybody. And that's like $200.
Right.
Now you can raise the rent on 12, even a $50 raise on 12 properties, $600 a month. That starts being an impactful amount. So yeah, you're at 10 years, it is even more so happens at 10 years. And that's where people have a hard decision to make. Are they the Coach Carson, lazy Dion, small and mighty? That's enough. The magic thing, knowing what is enough. And now I can go and goof off for the rest of my life. Literally never have to work again. When a tenant calls me and says, the little spinny thing in my dishwasher broke because they jammed something in there and it melted, I go, yeah, I'm going to call a handyman, tip him a bunch and go down. I don't even have to think about it. But when I'm starting out, that's me getting in my car, driving to the tenant's thing, figuring out what's missing, going to Lowe's and Home Depot, finding out you have to order it on Amazon. Now it's like a 2-text thing, right? Because I have enough. But at 10 years, you're going to have to decide. You're 54, you'll be 59-ish when you're there. Right. I'm 55, right? So we're close in age, but I wanted to retire early 50s. So my 40s were spent growing a company for someone else. Like motivated hard charger, 12-hour days, 7 days a week. Like we had a crew working from 6 a.m. to midnight. I was available the whole time.
Yep.
I didn't want my 50s to be spent on my business or their business. I wanted my 50s to be that year, that decade of I have the health, the ability, and the time. And my kids, what are their days off? I structure my time around their days off so we can do stuff together. In my 60s, I don't know if I want to say this. My brother retired at 50 and he's now 60 and he's really got some health concerns. Mm-hmm. If he worked until 60, which he could have, because this last decade of me and him traveling and doing all this stuff, he's outpaced me on hikes and done all kinds of things, right? Always up before me, doesn't take as many naps as me. But at 60, it's hitting him and we didn't expect it. What's going to happen to Brannon at 60? Do you want 1 year? You're going to hit 59 and you go, yep, get at least a year, right? Because if you don't, at the 10-year mark, if you go, look at all these levers I've got, I could go right now, pull out $2 million in equity and still be under 70% loan to value, add a crap ton of rentals to my portfolio. Who wouldn't want $2 million to just add a bunch of rentals to their portfolio right now? To me, that would be a negative.
Here's where I'm at today. And I know some people are probably listening on my side too, and thinking through how I'm going to phrase this. I don't work but maybe 15 hours a week. Sorry, not a day.
Your wife is in the next room.
I was working 15 hours a day a few years ago.
Your wife is listening. Be careful.
I know. I got to be
super busy.
Yep. I am busy. I can look busy really good, but I work about 15 a week. And I love that 15. I can leave the business and be gone for a month today and still make the same money. I have the freedoms today. I go to everything with my kids. I don't miss anything now, and I'm the owner. Now that's different. I'm an owner of the business. I have those freedoms. I've told Mark this before. I could retire today, and I mean that. I can retire today. I am choosing to stay here at this moment. I had the value of the company. I'm talking to somebody Thursday that wants to buy the business. I don't know if I'm going to or not right now. I like what I'm doing. I'm in a unique position. I have those freedoms. I have taken a month off before, and I will take a month off again. I do some of those things. I'm gone. I'm at all my kids' stuff. it's deciding, do I want to hold this company for one of my kids that they say they want to be in the business? Because I got one that says that. And so I haven't pulled the trigger because I'm thinking through that. I want to make the right decision. She wants to come, but it's going to be 4 or 5 years before she comes. Do I want to stay for 4 or 5 more years? I'm debating that. So I have that luxury of the gift of time now. So that's a little different.
Well, yeah. I mean, again, we're right back to there's no right way. There's a right way for you. How old are your kids?
They are 19, about to turn 18, and 14.
Right. So you've got a teenager to tie into there too. It's very different when you're like, okay, I'm gonna
Yeah.
take a month off. I'm gonna go do something. I'm gonna be around for your kids. My kids are in their 20s.
Yeah, you're right. That
And
makes it a
30s.
little different.
Right. So like next Tuesday, guess what? You know what I'm doing next Tuesday?
You're going to be with the kids, I'm sure.
Nope. I'm getting on a
Nope.
plane and going to Thailand. I had to apply for a visa and then extend the visa to be there because I'm going to be there at least 3 months. I'm going to be there until February, and in February I fly from Thailand to Vegas for the one rental at a time event, and then I'll decide: do I want to come back to Washington or do I want to go back to a different country? Because of the time freedom, it's like it's hard to associate. People always talk about it's kind of like having your summers off when you were a kid. But even that had a ticking clock of going back
You're
to
right.
school.
You're
Or
right.
when you graduate, it's okay. I've got a ticking clock too. My parents are going to kick me out. I got to have a job to pay for things. Like there's always a timeline. I have a life sentence of no return. Like there's not even words to describe it.
Yeah, I agree with you. It's a different time freedom than I'm at right now with my 14-year-old. I have some limits. And so we have to get through that stage. And I think about all of that. So I don't have a full answer right now. And there's some things I'm going to share in February. I'm trying to speed up time and slow down time at the same moment. I'm speeding up time with my investment strategy, trying to get there faster so that then I can slow down time. I do think things are changing in the next 3 years, maybe 4 years when Hudson graduates high school. That's going to be the moment I'm probably choosing to, whatever you want to call it, fully retire. I feel like I'm semi-retired now. And so I'm looking at I look at what you're doing and I'm thinking about those things. I just can't, I structurally can't do them just yet because Hudson's 14.
Yeah, no, I totally agree. I mean, there is also like a way out there thought of you homeschool them and you guys do what Chad Carson did and you just spend 18 months in another country and expose your teenager to a culture that they're just never going to have a chance to see.
I have thought of that too. We have broached that subject and the answer was absolutely not from the kids and from my wife. If they turn out dumb, it's going to be our fault.
Well, they're definitely going to turn out dumb if they're in the public or
We
private
don't do
school.
public school.
Okay.
I'm not part of government schools.
Whole nother topic for debate there.
Yeah. But can I go to something you mentioned before? You said something about new construction and that I have to get max market rents. That's basically what you were sort of describing, or did I have that right or wrong?
So if you do a new build, you have to get max market rents. If you stick yourself in the thing where you're doing the work yourself, you can mitigate some of the cost of the build. So
Because
yeah,
the way I underwrite it, and this will be some of what I talk about in February, because I really think about that when I'm giving somebody counsel for new construction. The way I do it to mitigate that is I want 10% cash flow at low average market, which is 5%. I go 5% below. I want 10% cash on cash return at 5% below market rents. And I want to know where break even is. And I look at break even. I need to be at least 15% below market rents or better, makes it a good deal. So I do mitigate.
What time of the year are you timing this with? Because rents fluctuate 15 to 20% depending on the time of year. I mean, there's a massive, it's year over year. We're progressively always going higher.
You're right. You're
There's
right.
certain
I
times
look at,
a year where you can go, yeah, this is lower than last year, same time.
I manage about 250 doors. So I see these and I know where the fluctuations are, and I look at all of that. So I'm looking at the trend lines, both in the wintertime for us versus summertime. There is a variation. I'm not seeing 15%. I'm only
Right. We're not
seeing
in Siberia where the lumberjack landlord is,
right.
where
So
you
I
die
know
if you get
because
locked out of your
Texas
house.
doesn't have winter, but maybe one day a year. You know?
Right.
So I do look at that. You're dead on right. There is a difference in the timing of the year. So I look at all of that data set and am trying to figure out what average is throughout the year. And then I mitigate it saying, okay, I want to be at 5% below. I do it now. I've switched my strategy. When I've got a fourplex, I'm giving a whole lot here, but I've got a fourplex that I was having a lot of turnover, and I'm trying to think through how do I that original build. I learned a lot, and I'm going to go through things I learned off of every build. I did 2-bedroom. It was stacked. Well, guess what? I have a lot more turnover. I tried to mitigate it with sound dampening as best I knew how. I did spray foam. We did certain things on the flooring. We've done lots of things, but I still have more turnover on that property than I do on every other.
When you say stacked, you mean an up-down unit?
Yes.
Yeah. I own one.
I'll never do it again, and I'll
one I'm
never build
selling.
it again.
It's one I'm selling, and it's the one I did the BRRRR in. And
Yeah.
I didn't buy it because of the building. I bought it because of where the property is. I was retired, and I was like, yeah, I want to live on the water. I want to walk down to the ferry and go wherever I want. And so that was the reason for buying this. But it's also an up-down unit, which is why I'm less likely to move out and turn it into a rental, which I could absolutely do. I get way more rent for this than my other units. It's 2-bedroom, 1-bath each unit, just like some of my other ones. And those ones rent for 21, 22. This one would rent for 27, just because it's right on the water. I'd still rather not own an up-down unit.
Yep. And what I always talk about is you get a base hit, but it becomes a home run from what you learn from it, if you learn from it. Not just having one purchase 10 times over. You've got to have one purchase, learn from it, get better and better and better. That one I learned. What I have done to mitigate the vacancy time is going even lower average rents, being under market. And I was running the math saying, okay, if I'm $50 less than even low market, I have less turnover. And I've started to experience that so that my net bottom line, what I bring in for the year, is up, even though I'm getting less rent. So I'm constantly tweaking and learning.
You'll also get a better quality of tenant if you're that far below area average, because you'll find the people who make bad financial decisions just rent a place. They don't do a market rent study and figure, okay,
Right.
These ones are averaging 18, but I can get this one for 17, 20 or whatever. But the people out there who actually look at their finances and go, okay, I've done a rent study. This is the average. These ones over here that you own are a little bit below. Let me find out why. And they go, it's just as good as the other ones, but it's lower. Then you get a tenant that's in there that doesn't always have a financial thing blowing up in their face because they just make poor decisions.
You're right. I've experienced that. So I've had a couple of those rentals. These are solid people. And they're like, you know what? We'll sign a 2-year lease. Because they know the value, and they mentioned it. We've looked, and here I've got almost brand new units at way below brand new unit price, and they still cash flow. These are the ones that cash flow at $250 a door, but I'm getting less transition, and my net bottom line revenue coming in is growing. So I'm learning, and that's what we're all, that's what we all share. Those are some of the things I'm going to talk about. These are the lessons you learn.
We definitely learn along the way. If somebody talked to me in my first years of investing, none of it sounds like I had a plan. It's getting to the 10-year part and then thinking, okay, how would I do it if I had to teach somebody what I was doing? And that's when I started learning. I had no idea what my net worth was until I sat down to do a video on what came first, $1 million in net worth or $1 million in debt. So if you start from the beginning thinking, if I had to teach somebody how to do what I'm doing, if you had to teach somebody how to, this is how you do a build, this is the format that would keep tenants the longest, and you had to teach them, here's how you structure your rents, and you had to teach them, here's how you do your debt, you can do that now, right?
Yeah.
And we look back, it's not like you started from that. I don't know that hardly any of us start from day one going, we just go, yeah, I'm going to build this and see how it goes.
Have you heard of the principle, the 4 levels of competency?
I don't think so.
There's 4 levels. So hopefully I can describe it right. So level 1, we all start at. We're all, and you've mentioned it too. When we're learning, we're reading books, we're watching videos, and you learn about, let's just say it's 70%. There's only so much you can learn before you get in the game. You've got to get into the game. You've got to have your first rental. You and I sat there and we watched a guy that first year. We were at a lunch together at the ORAD event, and that guy that talked about he didn't buy a property he's been looking for 7 years and never bought. I don't know if you remember that. You and I looked at each other and I thought, oh, how sad. This guy has never got into the game. There's 30%. Let's just, you say it's 30%. You don't know what you don't know. That's level 1. You have to get in the game. Level 2 is I know what I don't know. So now you're starting to learn because you're learning it firsthand. It usually takes firsthand learning. Level 3 is, let me see if I can get it right. I know that I know, I think is level 3. Level 4 is basically, you know it so much internally, it comes natural and you don't even think about it. And that's where us as teachers, the reason I'm doing the YouTube channel, there's many layers to the reason, but some of the reason is for me. Me teaching and trying to remember when I don't know helps me internalize it that much more. And I'm trying to get better every day of remembering when I didn't know and being able to explain it as best I can.
Yeah, the highest form of learning is teaching thing.
Yes.
Sometimes my kids will hear me on a YouTube video, or and one of my daughters listens to one of my books to fall asleep. But they'll say things like, you quote that the FHA loan came out in 1934, and here's the reasons why. And then you'll quote that the 5% down payment came out November 18th, 2023, and all this. And then, but you forget birthdays and holidays. And I go, no, I forget I have kids. I haven't had to teach people what it's like to have a kid. I haven't had to teach people what it's like to have a birthday or a holiday, but I am teaching people when I'm doing something. I'm thinking, if I had to teach this, real estate and investing and financial freedom. It's not that one has more value than the other. It's just that makes more long-term, ingrained, natural coming memories.
Yeah. So I'm trying my best, and I know you've observed what I'm doing. I'm trying my best to give another complementary perspective. I think we all are very complementary in the direction and our thought process of how we're doing it. And it's increasing credibility by the month in the entire investment community, because ours is lasting and less chance of failure. It's that more slow, steady progression. But all of us that come with that teaching heart, I think we're in alignment. And that's why I love being in this group, is we're sharpening each other in some of these discussions. Where we're different makes us better. But it's still relatively in alignment in the perspective of what we're trying to accomplish.
Yep, Lynn, the birthdays are in the calendar. The holidays are in the calendar.
Yeah.
Each kid has a contact in my phone with their favorite foods, their favorite drinks, their whatever. I have a TBI, so I have memory issues. So I put all of that in there. And that's actually how I run my business too. Every unit, not just every property, has a contact, not the tenant, but the unit. Like it'll say Tumwater Triplex Unit A, or whatever nickname you give it to. My fourplex, it's Rocinante 1, Rocinante 2, 3, 4, whatever. In that is all of the information that I might need. So if I'm going to see a tenant there, I can go, okay, this is the one that just had a kid, got married 3 months ago, had the dishwasher replaced last year, whatever else has gone on at that place. I look it up, I refresh myself when I go there. my kids would never make it this far into a live. When I go to hang out with my kids, I look at their contact. Like, it's fresh when I go to do that. Yeah, it sucks, but
That's what I have a wife who is the opposite of me. She can remember everything and every mistake I made since the days we were
she's
dating.
got a file that she
Yeah.
refreshes herself
Yeah.
with just before every argument. Oh yeah.
Yeah. I can remember numbers, but because she's more of a people person than I am, she remembers relationship details. And my natural is I remember number details.
Have you heard of
She
the
is not.
study of they put 100 men in a room by themselves, one at a time, and 100 women in a room by themselves, one at a time? Have you heard that study?
I know I have not.
So the idea for the study, and this is where I hate my memory sucks. I can remember stuff like this, but my son's middle name, which is now his first name, I have to remember. But they put people in a room, and the concept was, who's going to stay in a room longer, men or women? If it's quiet and they have nothing to distract themselves with, and they can come out whenever they want, they can stay as long as they want. I don't even know what the result was, but here's what the question was that struck with a lot of people. When they came out, whether they stayed in for 2 hours or 3 hours or whatever, 45 minutes, whatever it was, they asked them, what did you think about? And most men, as you would think, if we're locked in a room by ourselves for an hour or two, sex, sports, stuff like that.
Yep.
They asked women, do you know what the women thought about when they were locked in the room for an hour by themselves? This is something men don't do. We can't even conceive of this. The women said, I replayed conversations from the last couple of days in my head. And that's a thing that women do. They go, you see it. They'll come back and hey, 2 days ago when we were talking in the car driving to the store, you said this, and I just want to confirm if this is what you meant. Sure, we don't realize how important that is. That is an actual. I'm sure there's guys that do it too, and there's girls who don't do it, but there's a difference to where her remembering the relationship stuff, like you mentioned, and you remembering the other stuff. It's like you complement each other.
Yeah. I think of another story with this same actual kind of concept that you put a group in a room and something horrific type happens. The women huddle together and the men spread apart to defend. And I think about that a lot of times. My natural reaction is if there's something horrible happening, I need the space to defend, and my wife and the others want to gather together, more relationship, and we're more. I'm just saying me. I'm more in that defender. We had a situation the other day. Something happened at our house, and there was somebody at the window, at my daughter's window. My daughter comes in there, huddled together with my wife. I get the gun and the super powered flashlight that'll kill you. I'm out the door and I'm saying, I'll kill you. And I said it in a way, I meant it. I don't know. My natural reaction is, but I need the space. I don't need to huddle. Get away from me when something serious happens. I need space to think, I guess you'd say.
No, it's the natural reaction. If you picture parents defending a kid, I picture the mom being super lethal. She's got her body wrapped around the kid, gun pointed out. She's got good side alignment, trigger control, all of that. She'll take you out, right?
Mm-hmm.
But the dad's outside hunting down the person that could be a threat. Like that's the difference. They're both just as good at it, but there's a different way of doing it. And Lynn, no, we don't replay conversations. I had to look at your chat again to remember that I wanted to respond to that because that's already in the past.
I do want to clarify real quick because I'm getting a lot of text messages here that I did not set up Brannon for this live stream. He requested Dion.
I did. I wanted this challenge from Dion. I genuinely did. I wanted to hear.
So let me. We had the debate at the beginning. Let me ask you a question, Brannon. Okay. You ready? This is your answer, your chance to answer, and I will set the mic down, Charlie style, not interrupt you. If you do a new build now, and you can get a 50-year loan, and your payment is less, Or you can get a 30-year loan and your payment is more, or you can get a 15-year loan and your payment is more. The 15-year loan, you pay the least in interest. The 30-year loan, you pay mid in interest. Add 20, you pay the most in interest, but you have the most cash flow. Which loan product is going to work for you?
For me, between those three, I think for me, the optimum that I feel comfortable with is the 30. I like the principal pay down feature at that percentage pay down more than the 50. That's where I lean.
Okay. But not the 15.
Yeah.
Not the 15 because the cash flow is not where I feel comfortable.
I think what I would like to add, me and Cody talked about this yesterday, and I think that's why Dion is so passionate about this topic a little bit, is he's seeing a window of opportunity, right? So for those that the 30-year may not even work for them, right? If the 50-year allows them to take advantage and get the property or do this build, then that's the one they should use. And like Dion is saying, right, there's this small window that people need to take advantage of, and I think that's why he's so
I agree.
passionate about this topic.
Now I understand better what you're saying. I agree with what you're saying. For me, I will still seize those opportunities. I don't need that extra $100 cash flow. So I will still be able to seize them. But for those that do, that probably is the better decision for them, that they can seize it that much faster.
Imagine the person in 1970 when so many people had a 15-year mortgage and the 30-year mortgage started to be mainstream, when the homes cost $20,000 or $25,000 and they nailed down a 30-year mortgage. And in the next couple of decades, prices doubled, tripled, went to $150,000 from $25,000 just because we now had 30-year debt. This is that window.
You're right. You know, I know where enough is, and I'm kind of where you are. I know where my enough is, even like Coach Carson. I figured the number is 22. So I'm not far from it. I'm building number 13 and 14 right now. I've got the land to be to number 18. So I'm not far. I'm good with enough at 22. There's some joy and freedom knowing, being comfortable in enough. And I'm almost there. And I appreciate where you come from. You have reached a different, unique freedom being a lower number, knowing when your enough is. Now, that doesn't mean you might buy a few later for joy, just wanting to do it, but you're comfortable with enough. Always striving for more sometimes has not a penalty, but it has a cost. And I'm looking forward to getting to enough, and I'm almost there.
Right. That's the balance you have to find. It will always mathematically make sense to work another year to invest in another asset. And so the investments that I'll make going forward I will factor math in, but they won't be based on math. It'll be quality of life. I want acreage. I want animals. I want to get out of the city that I'm in. So Jack said, did I see Zuber's response video? And just so everyone's clear, the type of friendship me and Zuber have, before I did the reacting to video when he called me out in his daily financial update, I texted him and I said, hey, I'm going to make a reacting to video because we disagree. And I'm just making sure that you're aware. And I'll send you a link.
I figured that.
And then he said, yeah, I'll make a reacting to video with the infinite monetization loop of reacting to. And then tomorrow we're going to do it together. Jack, did you see Zuber and Jason Hartman make the video where Zuber had to go, I have this mentally challenged friend Dion who has a differing opinion. Sure, I can get around that. But then Zuber had to sit there and go, hang on now. This guy who's been doing it over 20 years, who understands and came up kind of the term that gets thrown around is inflation-based debt destruction, had some solid arguments. Now, Zuber still sees it from the perspective of his mom, right? She has a paid off house. It's one of the reasons why she could retire. But she could also have a lot more equity from a 50-year mortgage and have not paid as much payments every month for all of those years. And she has the option to downsize, and she has the option for a reverse mortgage, and she has all those other options because life is easier when there are options. That's for sure.
Yeah.
Zuber's not right or wrong, and I'm not right or wrong, and Brannon, you're not right or wrong.
Right.
We're all right for us. The difference is, I think Zuber is trying to warn off the average home buyer to the dangers of the 50-year.
Mhm.
I'm trying to warn off the average investor and home buyer not to miss the window of opportunity. Like, so we're all coming from our own angle.
And they're all healthy angles.
Unless
Yeah.
it's Matt. Matt's always wrong.
Well,
Now,
no, go ahead, Brandon.
I've thoroughly enjoyed this. It has been good to sharpen each other and hear each other's perspective. I am learning always, and to ever say I've arrived, I'm not. I see all my failures. I see all what I'm still learning, and I appreciate this group, and that's why I knew Dion would challenge me really hard. I wanted it because I wanted to flesh out my thought. Whether I agreed or disagreed with him, it makes me better. And so I loved it.
Yeah, it's always a great time. And Dion, you'll be going live 4 p.m. Pacific today.
4 p.m. Pacific. Apparently, I'm not going to get much sleep today. I've got Zuber joining our course call today at 11 o'clock.
Oh, all right. Do you have a topic for your live?
I am going to run Zuber through 9 specific questions about his portfolio to help the people in the course today.
Nice.
And I actually told Mike, I said, hey, I've got 9 questions I'm going to send you. I've researched these 9 questions. I can send them to you. And he goes, nope, I don't want to be prepared. I want to be blindsided. And I was like, cool. That's the kind of guy he is. So it's pretty cool.
Absolutely. Brandon, any final words today? Any thoughts?
I'm going to do a video from my perspective and using Dion. I've got my glass whiteboard now. You and I are the ones that use the whiteboards quite a bit. I love it. Trying to engage multiple senses to learn. And y'all need to read, Dion. If you haven't read this book, I think you would appreciate it. The 7 Laws of the Learner.
I'm familiar with it. I think
Bruce Wilkinson wrote it maybe early 90s. And I think about those principles and take teaching very seriously. I enjoy it.
Thanks everyone for tuning in. I'll be back tomorrow, same time, 10:45 a.m. Eastern time. Catch Dion live today, 4 p.m. Pacific, and see Brandon next week, Tuesday again, same time. So thanks everyone tuning in. Hope this was fun.